So I'd like to spend a few moments talking to you about the accounting and tax aspects to consider when you're preparing for selling your business. This should help to maximise the value that you get out of the business and also help the whole process to go as smoothly as possible, which should help the speed at which the transaction completes and minimise the costs for all parties. In a transaction, the buyer and the seller usually have slightly different focuses. So the seller will be looking to maximise the value that they achieve. That means maximising the price, but also reducing the taxes as far as possible. For the buyer, they'll be looking to understand and try to fix the cost so that they know the total cost of the transaction. That's buying the business itself plus the costs around the process, as well as thinking about protecting future profitability and value. And both parties will need to go through that process together. They'll be negotiating the price. There's a due diligence exercise to go through. There'll be lots of exchange of information around the accounting and the numbers in particular, and discussion around warranties and indemnities. So how can the seller best prepare? There are a few areas in particular where you can prepare, and the sooner you prepare the better, and this can be as much as 18 months, 2 years in advance. So we're going to talk about the specifics, and part of that will be the financial reports that you need to prepare, and also think about making sure that you understand what's in those. So there might be some technicalities in your accounts that perhaps you haven't had to give too much in-depth thought to before, but could be important to a buyer. And then also trying to project ahead to particularly areas that could be relatively sensitive within a deal situation. And then on the tax side of things, it's important to understand the tax position that you're in, and then from that position you can think about maybe ways in which the tax could be minimised or reduced. It's also important when thinking about the tax to understand what issues could be important for the buyer so that you can then minimise the impact for them and deal with it well in advance. So I'm going to talk through on the accounting side a few aspects of management accounts, estimates and variances, the balance sheet and working capital, and also adjusted profits and how they impact the price that will be paid for the business, and a little bit about the completion funds flow. This is how the money flows at the point of completion of the transaction. So the management accounts, normally buyers will ask it for at least the last 3 years, and they'll want some forecasts of the profitability, because what they're buying is future profitability. So they want to understand that what that looks like in the future. So if you can get into the habit of creating some management accounts that are easy to read and follow, are in line with the year-end accounts that are produced, so you don't have big differences between the monthly reports that you get and the year-end results, and then also have some forecast information. Now ideally you would have some management accounts that show the forecast for the following for the rest of the year and potentially even for the following year. And if your management accounts are then falling in line with those forecasts, that's going to give the buyer an awful lot of confidence when you then present them with forecasts from the date that they buy the business going forward. They're going to be able to put more comfort in those and more reliance upon those when they're arriving at the price that they pay for the business. So the suggestion is have a look at your management reporting, see if it's fit for purpose, try and look at it through the buyer's eyes, and if need be, get some help from your accountant to pull this into a shape that would be well presented to a buyer.